Hi, good morning, everybody. Oh, actually, it is good afternoon. Okay, this is topic. This is week 3, so we will start a new topic for discuss. In the previous lecture, I have covered every subtopic related to topic 1. In the topic 1, you have learned about definition of accounting, role of accounting, uses of accounting information, uh, two branches of accounting, which are financial accounting and management accounting. And then you have learned about types of businesses. Remember, there are three main types of businesses. According to activities, there are service business, merchandising business, and manufacturing business. And then also businesses can be divided into uh, three categories according to its ownership. Uh, these three categories are sole proprietorship, partnership, and companies. That is the first half of the topic 1. And then the second half of the topic 1 has been covered in last week. So you have learned about financial statement, components of financial statements, elements of financial statements, and also you have learned about principles and assumptions that we have used in accounting. Later, I hope, so this is the most important. You have to read the textbook. Check the, I think you have to read the topic 1 in the textbook, chapter 1 in the textbook. The textbook is very good. I think the textbook is very good. I have read the textbook, and then I found that it is very easy to follow. The language used is straightforward, very useful, a very good textbook. Also, you use all the materials that you can in the textbook system. If the eConnect system, you can watch videos, you can do exercise questions. There are many things there. Okay, this topic 2 is about the accounting process. Starting from this week, you will learn about how to do the accounting record. Okay, let's see. Okay, remember this. When you want to do the accounting record, the thing is like this. Let's say you have a business. You want to know whether your business is making profit or loss. So how to know whether your business is making profit or loss? To know that, you have to do accounting record. When you do accounting record at the end of the year or at the end of the month, you can calculate profit or loss. So in this chapter, you will learn about that, how to do the accounting record. So remember this, the accounting record process is started after a business do a financial transaction. Do a business transaction. Okay. So the recording process is started after a business do a business transaction. So business transactions, these are the examples of business transaction. If the business is sell something, buy or sell goods or services, then that is a business transaction. And then if the business borrow and invest money, that are also business transaction. Purchase land, building and equipment, pay taxes, distribute earnings to owners, pay wages to employees. These are all business transaction. After the transaction happen, you have to record. in your account. Okay, let's say you have a business. Every day you will sell something, or you will provide service to somebody. So that is one example of business transaction. After you do the business transaction, you have to record in your account. You have to record the transaction in your account. Okay, the steps that you have to follow or to do when you want to make accounting record for a business is called accounting cycle. In this slide, you can see there are four main steps or major steps in the accounting cycle. Okay, so in detail, it is like this. In detail, there are 8 steps in the accounting cycle. Okay, the first step in the accounting cycle is to do analysis. See point number 1 in this slide. The first step in the accounting cycle is to do analysis. When you do this analysis, you have to identify the type of the transaction, effect of the transaction on the accounting equation, and the amount related to the transaction. So we will see the detail later. But just remember, the first step in the accounting cycle is to do the analysis. The second step in the accounting cycle is to record the transaction in a book. We call it journal. And then number 3, at the end of the accounting period, maybe at the end of the year, you have to stop recording the transaction in the journal and you transfer all the journal entries into another book called ledger. So ledger is step number 3. And then after you have transferred all the journal entries into the ledger, you close the account and prepare or do step number 4. You prepare a trial balance. A trial balance is a document. You will see the detail later in this topic. After you have done the trial balance, you have to do the step number 5, which is doing adjusting entries. Adjusting entries like accounting record you have to do to make sure that all the transactions are recorded properly. You will see that later in this chapter. Okay, and then step number 6, after you have done all the adjusted entries, you will prepare a new trial balance. You will have to prepare a new trial balance called adjusted trial balance. And after you have done that, you do step number 7, which is to prepare financial statement. In this course, you will learn about how to prepare 2 components of financial statement only: income statement and balance sheet. And the last step in the accounting cycle is to do closing entries. You close all the accounts for the accounting period or for the accounting year. And then when a new year is started, you have to do step 1 again. So that's why we call the steps that you have to do when you want to do accounting record is accounting cycle, because you have to do step number 1 and then number 2, number 3, number 4, number 5, 6, 7 and 8, and then you have to do the same thing again in the next year or in the next accounting period. You have to start from step number 1 again. So it is like a cycle. This is very important. You have to memorize this, I think. Okay, if I ask you how to do accounting record for a business, then the answer is to do accounting record for a business, a person has to follow accounting cycle. Why? Because accounting cycle shows the step that a person has to do when the person want to make accounting record for a business. Okay, and then if I ask question like this, explain about the accounting cycle. So then you have to know accounting cycle has 8 steps. The first one is analysis, the second one is journal, the third one is ledger, number 4 prepare trial balance, number 5 doing adjusting entries, number 6 prepare an adjusted trial balance, number 7 prepare the financial statement, and number 8 is doing the closing entries. Very important, this one. Okay, so and then let's see, now we go in detail. Remember, the first step in accounting cycle is to do the analysis. This is the first step in the accounting cycle. Okay, so when you have to do the analysis step means you have to identify what is the type of the transaction that happened to a business, and then what is the effect of that transaction on accounting equation, and the amount related to the transaction. Okay, there are many type of when you have to identify the type of the business transaction, you have to know that there are many types of business transaction: sales transaction, purchase transaction, seller. You pay expenses transactions, purchase of non-current assets transaction. There are many types of transaction. Let's say you have a business, you sell something, you purchase something, you pay for expenses, you pay for purchase of machine, motor vehicle, etc. So these are types of transaction. The second thing is you have to know the effect of the transaction on the accounting equation. So this is the accounting equation. In accounting, we have one equation that we use all the time when we do the accounting record. The accounting equation is this one. It's like this in this slide. Assets equal to liabilities plus owner's equity. Okay, remember the definition of each terms first. Assets. What are assets? You have seen the definition of asset in the previous lecture. Assets are resources owned by a business. If you have a business, your business will have assets like inventories, cash, maybe building, equipment, motor vehicle, furniture, etc. These are assets. And then see the liabilities. Liabilities are financing resources requiring repayment, or we call it obligations. Something that assets are things that a business has to pay in the future. Like bank loan, account payable, etc. Owner's equity, the simple definition for owner's equity is amount owned by the owner of the business. So why assets always equal to liabilities plus owner's equity? So the logic is like this. Let's say you start a business. When you start the business, that's not easy to explain like that. Okay, let's say you go to a grocery shop. Everything that you can see in the shop is asset. You go to a small grocery shop, for example, let's say you see everything there, furniture, inventories, maybe personal computer, equipment, etc. Let's say everything in that grocery shop is like $30,000. Let's say $30,000. So that are assets. The assets of the business are $30,000. And then um, let's say you ask the owner of the business, what is the amount that he has invested when he started the business? So let's say the owner said when he started the business, he invested $20,000. Okay, so assets of the business are 30,000. But when the business is started, the owner put $20,000 into the business. When the business took the owner put $20,000 into the business, it means that the 20,000 is owner's equity. So you see the shop assets are 30,000. The owner said he invested or put 20,000 when he started the business. So the difference, assets 30,000, owner's equity 20,000, there is a difference of 10,000. What is the 10,000? The 10,000 is the amount owed by the business to other parties. Maybe the business make a bank loan, 10,000. So that's why the owner invested 20,000, but the assets are 30,000. Why the asset is bigger than the owner's investment? Because the business borrows from somewhere. Okay, so that's the logic. Assets always equal to borrowings or liabilities plus the owner's equity. All business asset. Another way to think about it is like this. You go to a shop and then you see, okay, let's say all the assets in that shop are equal to $25,000. And then you ask the owner of the business, let's say the owners of the business said his business has like total liability of 5,000. So the assets are 25, the liabilities are 5, and then what is the owner's equity? The owner's equity is 20,000. Or something like this. You go to a shop, but you cannot calculate the value of the total asset of that shop. So you ask the owner of the business, how much money he has invested when he started the business. Let's say the owner said he invested $15,000. And then you can ask the owner of the business, this business has how much liabilities or debts? And he said the business has $15,000 debts. So you know, then you know how much is the total asset of the business. The total asset of the business is equal to the owner's equity or investment plus the debts. Because when a business wants to purchase something, the business has to use the owner's equity or to use debt to pay for the purchase. So always remember, in accounting, the accounting equation is assets equal to liabilities plus owner's equity. Okay, remember this is step 1 in the accounting cycle. Okay, I will show you. I have told you the recording process is started after a business do one financial transaction. So in another way, in another way to say it is like this: if you have a business and then you want to record or to do accounting record for your business, the recording process is started after the business made a transaction. So let's say today you want to do the accounting record, and then when your business sells something, after the business sells something, you do the record, and then the record is started with the analysis step. So analysis step is you have to identify the type of the transaction, the effect of the transaction on the accounting equation, and then the amount related to the transaction. So see here, in this example, the transaction is a business borrow money from bank, for example. So you know that this transaction is a borrowing transaction. So the second thing that you have to do in the analysis step is to know the effect of the transaction on the accounting equation. So imagine if there is a business and then the business borrow cash from bank. Let's say the business borrow 10,000 from a bank. So what is the effect of that transaction on the asset of the business and the liability of the business and the equity of the business? So the effect is when the business borrow money from bank 10,000, the asset of the business will increase because bank will transfer 10,000 cash into the business. So the business asset cash of the business increases 10,000. At the same time, liability of the business also increased by 10,000 because when a business made a borrowing or borrow money from bank, that is a debt or liability. So two things happen. First, asset of the business increases. Second, the liability of the business also increase. The asset is cash asset, the liability is bank loan. So always remember, one transaction is always related to one effect in the left side of the equation and also one effect in the right side of the equation most of the time. But in some cases, one transaction will have two effect on the left side of the equation only or two effect on the right side of the equation only. Okay, let's see the second transaction. Okay, owner of a business invest in the business. Owner of the business invest in the business means let's say this is your business, you put cash 5,000 into the business. So how to what is the transaction is that the owner put cash or any asset into the business. So and then the second thing that you have to know, what is the effect of this on the accounting equation? Okay, see this effect. The effect is when the owner of the business put something into the business, the asset of the business will increase. Let's say the owner put $5,000 cash. So when the owner put $5,000 cash into the business, the asset of the business, asset cash of the business will increase. And then in the right side of the equation, there is no effect on liability. The business does not owe to anybody, but the equity will increase. The equity is the amount owned by the owner of the business in the business. So always remember, when an owner of a business put something into the business, the asset will increase. The equity is also will increase. If you can remember, I have told you the equity account, the owner's equity is related to at least 4 accounts: capital, withdrawal, revenue, and expenses. So in this situation, the account capital has increased. Okay, pay off a note. Pay off a note means the business pay back the loan that the business has made in the past. So see the first example here is the business borrow money from bank. Now what is the transaction now is the business pay back the loan that the business made from the bank. So what is the effect of that? Let's say you have a business, your business pay back a bank loan. The first thing that will happen is asset will decrease, because when a business pay back a bank loan, there is a cash out. Cash is an asset, so there is a cash out. So the asset cash of the business will decrease. See the arrow here, asset decrease. The second thing that will happen is the liability also decrease, because let's say the business borrow 10,000 from a bank. Today the business pay back 1,000. So cash decrease by 1,000. The amount borrowed from the bank also decreased by 1,000. So you can see here, the amount, the total in the left side of the equation is always equal to the total in the right side of the equation. It always balance. So that's why we call it accounting equation. The total assets always equal to total liabilities plus equity. Okay, see the next example. Purchase equipment. Purchase equipment, like I said earlier, sometimes one transaction will have two effects on the left side of the equation only. So here is an example. Purchase equipment. What will happen when a business purchase equipment? Let's say you have a business. You purchase equipment $3,000. So the thing that will happen is like this. When you purchase the equipment, cash goes out. You have to pay 3,000. So asset cash decrease or goes out 3,000. At the same time, you will get the machine. The machine goes into your business. The value of the machine is 3,000. So if a business purchase an equipment, the effect on the accounting equation is like this. There are two effects on asset only. No effect on liability, no effect on equity. The effect on the asset is asset equipment increase. Our example is 3,000, and asset cash decrease. And then this is an example of a situation where there are two effects on the right side of the equation only. Borrow funds to settle a debt. Okay, so sometimes a business, they do something like this. A business has we make it a simple example. A business has a bank loan, but the bank loan, the interest for that bank loan is like, let's say 10%. And then at one time, another bank offer the business to make a bank loan at a cheaper interest rate, maybe 8%. So what will the business do? The business will borrow, make a borrowing from the bank that offered cheaper interest loan, and use the amount that the business borrowed to pay back the existing loan. So if that kind of thing happen, the effect of that transaction on the accounting equation is the liability will increase. That is the new bank loan. And another effect is liability will decrease. That will happen when the business use the cash got from the new loan to pay back the existing loan. Okay, so that thing happened. So this is the first step in accounting cycle. You have to do the analysis. The analysis means when a transaction happen, you have to identify the type of the transaction, and then you have to know the effect of the transaction on the accounting equation. Let's say I make another example, the last one. A business a business, let's say a laundry business, purchase detergents from supplier in credit, what will happen? A laundry business purchase $1,000 detergents from supplier in credit. Okay, that is the type of the transaction is purchase transaction. What will happen to the asset of the business? The business purchase detergents $1,000 in credit from a supplier. What will happen to the asset of the business after the purchase of the detergents? The asset will increase. The laundry business will get detergents. The supplier will send the detergents to the laundry shop. $1,000 in value. That detergents are assets. In accounting, we call it surplus asset. So asset will increase by 1,000. Another effect is remember the laundry business purchase the detergent in credit. When a business purchase in credit, that is a liability because the business has to pay the 1,000 in the future to the supplier. So the second effect is liability increase. Asset detergent increase or asset supplies increase. The second effect is liabilities, which is account payable, will also increase by 1,000. In accounting, if you have a business and your business owe money to the supplier, you have okay, in accounting, if you have a business and your business owe money to a supplier, the amount that you owe to the supplier, the amount that the business owe to the supplier is recorded in an account called account payable. It is a liability, a short-term or current liability. Okay, thank you very much. We have I have explained about the step 1 in the accounting process, in the accounting cycle. Do not forget to write your name and matric number in the comment section so that I will take it as your lecture attendance for today.